Your company's thriving and you're thinking of going public. We have what you need right here on the Leadership Voice. Welcome to the Leadership Voice. I'm your host, Jay Barbuto. Today's show is about taking your company public. Joining us today are Dean Stoker, co-founder and executive chairman of Alteryx, and Robert Grant, founder and CEO of Strathspey Crown. We also have a great leadership lesson being delivered by Professor Lorenzo Bizzi. We have a lot of great things coming, so let's get things started with our quote of the day. Today's quote comes from IPO consultant B.M. Agarwal. An IPO is a moment of truth for a company as it faces the scrutiny of the public markets and the expectations of its investors. Our first guest today is Dean Stoker. Dean is the co-founder and executive chairman of the board for Alteryx, a computer software company specializing in data analytics solutions. Dean founded Alteryx in 1997 and led the company as CEO through October 2020, achieving solid organic growth and a successful IPO in March 2017. He is also a proud supporter of the Giles O'Malley Center for Leadership. Please welcome a cerebral and inspirational leader, Dean Stoker.
Jay, thanks for having me here.
It's great to have you on the show, and I look forward to having a discussion with you about the IPO process.
Ooh, that's going to be a good one.
It is going to be a good one. So let's start things off. Maybe we could start by you sharing a little bit about the Alteryx story of how it went from idea to IPO.
Well, I'll condense it because it was a 20-year-old overnight success. So first 20 years of my career, I worked for data companies, and I realized that the ultimate value of data was when you made it ubiquitous. And the only way to get ubiquity is to wrap it with elegant, easy-to-use software and an analytics layer that would make the data dance to tell better stories, to get bigger outcomes. So I quit those companies because they became mediocre at all three things. We said we're going to create a pure-play analytics software platform, and we're going to democratize this to the 50 million citizen data scientists that exist in the world that would otherwise live in complex VLOOKUPs in Excel. Started in 1997, and like a lot of startups, we went through the whole range of motions from services, because we were self-funded for 14 years. We went from services to products to platform, and then it was really onto the races to try to figure out the product market fit, because that's really the primary role of a CEO. As much as I despised raising money, I actually raised $163 million in 3 rounds over 4 years, starting in 2011. Our C round was $85 million in 2015. Took the company public in March of 2017.
And so the company was doing well. So it didn't have to go IPO. You didn't have to go public. But what made you decide that IPO was the right step for Alteryx?
Well, I really never thought about an IPO. I went into this venture to build a great company to change the world. I think we've accomplished that. I think when you do a Series A and a Series B, and you're starting to step on the gas and starting to scale, I realized that after plowing $20 or $30 million a year into marketing and having our customer acquisition costs rise pretty high, that we didn't have brand awareness. And for me, going public was all about brand awareness. In the end, it's just another fundraising event. I think we raised $113 million in the IPO. So it's certainly not an exit. Yes, there's some liquidity for founders and some of the holders of options, but it's really just the beginning. It's the first round. It's almost like starting over again.
So what goes into the process of going IPO?
Well, it's fairly complex. I think that you've got to have the right team, first of all. They've got to have the discipline and the knowledge about what it takes to go public. for us, it was, bringing on a bunch of lawyers and bringing on a bunch of accountants. And even prior to the preparation of the confidential S-1 that we filed, it was making sure the company was ready. And again, my intent was not to go public. My intent was to be a great company, whether it was a strategic takeout or going public. So in 2015, December of 2015, almost as a test of my team, not just a test of the company's ability to execute, I did a pre-IPO audit. And turns out a lot of my team didn't want to go public. And so that was a great lesson to figure out who did I have to take out and change in order to have the right team to go public. And then once you have the right team, it's about the discipline of continuing to run the company while a whole group of the organization is preparing the S1 and all the necessary filings to go public. I tried to stay out of that piece of it. I told the team, I'm not going to be involved in the writing of the S1. I'll review it. Our team had enough expertise and knowledge about the company to figure out the S1, but there was a lot of people involved. It's a lot of work.
So what are some of the other decisions that have to get made in that process of going IPO? What are some of the choices that CEOs need to make that really can be difference-making decisions?
Well, I think, first of all, making sure you have the right team. Second of all, knowing how much float you're going to sell, knowing what bankers to choose, try to understand the kinds of investors you might want to have on your list of investors, understanding the repercussions to the company, because running private, even though I was a fairly transparent CEO running private, a lot of that has to go away when you become public. There's just some discipline and rules that you can't be quite as transparent when you're a public organization.
Okay. And then thinking about the banks part, and you said that you have to choose the banks. Tell me more about that and what goes into those types of decisions. Like what happens if you choose a bad bank or a good bank? How does that change the IPO experience?
Well, it's interesting. One of the members of my board is Chuck Corey, who ran tech investment banking for Morgan Stanley for 25 years, probably took more companies public than anybody on the planet. And he said to me, I was glad he didn't pressure me to pick Morgan Stanley. He said, they all do the same thing. Make sure it's a bulge bracket bank. Make sure they have a good team. He said, pick the team that you trust the most. And so I was investigating not the mechanics of the bank. They're all market makers to a certain extent. I chose the team that I connected with, that understood that this was not an overnight success, that they knew this was my baby. And we picked the right team.
Okay, terrific. Tell us about the pre-audits. How do you make those go well?
Well, you don't really have any choice. We hired KPMG to do the pre-IPO audit, almost a test of the strength of my team, but also to understand how prepared the company was for any kind of an exit, whether it was an entrance into an IPO or a strategic takeout, or just to run as a private company for as long as we could. And so they come in and, they uncover all the issues that might get you in trouble going public, and they give you plenty of guidance on processes and procedures and governance to cover off on all the details that you're going to be scrutinized for when you do go public. And it's it's a complex process, but it's a simple grading. It's red, yellow, and green. And turns out there were mostly yellows and reds. I think we only had one green out of the 10 or 15 things that we did the audit on. And we had a year and 3 months to actually fix those things so that everything was green when we did go public. So timing is pretty important. It's not, you don't wake up one day and say, I'm going to go public next week. There were weeks and weeks and weeks of preparation, and then months and months of actually making sure that the team was prepared.
So a lot goes into this. So thinking about this process that you've gone through and thinking about companies, and I know you mentor a lot of young entrepreneurs, early early phase entrepreneurs. What is your philosophy in terms of going public? When should a company go public? When should a company maybe stay private?
Yeah, that's a great question. I personally don't like to mentor CEOs that are early stage who say their goal is to go public, because I don't think they really understand what it takes to get there. I encourage them to build a great business, build great customers, driving great recurring revenue, and then you'll figure out what the exit is. If you're trying to figure out your exit or your entrance, a lot of people think the IPO is the exit. It's actually back to the entrance. You're starting almost over because now you've got public eyes and investors on you. So I tell them to take that off the table. In fact, whenever they say I'm going to raise money at all, I take that off the table. I think that raising money, whether it's from VCs, family offices or private equity, I think it's a mistake if you do it too early. You lose a lot of the valuation that should be going to founders when you do go public.
So a lot of things can present challenges during the IPO process. Can you talk or share maybe what some of the biggest challenges you faced with Alteryx going public during that process?
Well, the time management, I think, is critical. For me, I think it was a bit easier because I'm a go-to-market guy. I'm a sales guy. So I went from selling software to selling stock. And it was an easier transition for me. I would say that if there are founders watching the show, if you're a product-led founder, it's going to be a lot more challenging. And which is why a lot of product-led founders leave the company or step down from their roles before they go public, because it is a lot of work. There's a lot of work, and internally you can't do the same things you were doing before. I used to have all hands meetings every quarter, and I would tell the company everything that was going on, full transparency. And when you're public, you have to wait until after the public earnings call to have your all hands meetings for fear that, the private information is going to get out to the public.
So the skills that are required of a CEO can shift depending on what those skills may be
Completely.
Prior to public.
Completely. You have to be far more disciplined as a public CEO than a private CEO.
For you, it was compatible because you were kind of a marketing person. So you were just shifted your marketing focus.
Yeah.
But for a lot of people, they have to really think about whether they're the right person.
Well, it's grueling. It's not just the IPO roadshow. It's, going to 6 or 7 investor conferences a year. And after a couple of years, I finally had an agreement with my CFO that I'm not doing all these conferences because I have a business to run. And you can't take your eye off the ball, especially when you're public.
Now, if you could go back to this process, is there anything you do differently with your Alteryx journey of going public?
I don't think I would do anything different, at least understanding my circumstances, my own DNA, the preparedness of the company. However, if circumstances were a little bit different in the company, if I had better brand awareness, I probably would have done a private listing. Some of the great companies that have gone out on private listings, you avoid the banker fees, you go directly to, the investors, and, Palantir, Spotify, some of the Bitcoin companies went to direct listings. So I would have considered that had circumstances been a little bit different. And we went public at $85 million in revenue. And I think this year, just 6 years later, we're flirting with $1 billion in ARR. So, it's not like things have gone wrong.
You said some sixfold.
Well, it's a great story, and we're still just 1% penetrated of the global audience.
So if you went back and did it again, you probably would do it again.
I think so. It was kind of a natural path. It was It was a weird event, though. It was anticlimactic. For me, it was the 20-year journey to get there. That was
Not the event.
Not the event. I mean, I can remember standing on the podium at the New York Stock Exchange, and John Tuttle said, "When the clock strikes 12, push this button." And I said, "Well, no, I'm here to ring the bell." And he said, "That's the bell."
It's a doorbell.
It's a doorbell.
There's no bell to ring.
And I mean, it was kind of a letdown. It was fun putting your name in the book that only a few thousand people have been able to do in the last 150 years. But rewarding because it actually brought a brand voice to Alteryx. And today we're doing business in north of 90 countries. We support our product in eight different languages. So it's a lot of fun.
So what advice would you offer a company founder that's thinking of taking their company public? What would you tell them?
Discipline, discipline, discipline. If you can't accurately predict what you're going to do in a quarter, don't go. Wait until all of your finance team is in place. Make sure that your sales ops teams really understand what's happening. Investors don't care as much about the product, I don't believe, as they do about the financial model. Make sure your unit economics are managed the right way, and make sure your head is ready, because it's a different process, especially for those product-led CEOs. So slow down, don't rush into it. Make sure give yourself at least a year to mentally prepare for yourself and to make sure your team is mentally prepared, because it's a sea change. It's not the same thing that you were doing the day before the IPO. It's very, very different.
So it's grueling.
It's grueling.
Well, thank you, Dean, for joining us and talking with us about this process. We're going to have you back here in just a few minutes with our leadership panel along with Robert Grant, so you'll stick around.
Perfect.
It's now time for a feature segment of Leadership Voice. It's today's Did You Know? Today's Did You Know comes from stockanalysis.com. In the United States, there were 255 IPOs in 2018, 232 IPOs in 2019, 480 IPOs in 2020, 1,035 IPOs in 2021, but this number dropped to 181 in 2022 and likely just 150 in 2023. This recent trend indicates that more companies are choosing to stay private. Now let's get to today's Leadership Countdown. Today's countdown comes from Forbes.com. We bring you the 7 clear signs your business is ready to go public. Number 1, your reports are always on time and audit ready. Number 2, you have a backup plan for a delayed or no IPO. Number 3, you feel ready to share and defend your future plans. The number 4 sign is that you have a great story with numbers to back it up. Number 5, you have a large addressable market. Number 6, your forecasts are consistently accurate. And the 7th clear sign your business is ready to go public is an IPO would not make or break you. Don't go anywhere. We have Robert Grant in studio right after this word from the Giles O'Malley Center for Leadership. The Bringing Learning to Work program is our way of connecting the faculty of Cal State Fullerton with the business community of Orange County and Southern California. We have over 72 training programs that are available via distance or face-to-face. And the faculty come to your company and they deliver the training to your employees.
The Bringing Learning to Work program is really fundamentally, it's leadership programming. We do diversity and emotional intelligence training. We partner with Cal State Fullerton because they had subject matter experts in these fields, and we're really fortunate and privileged to be able to do that.
Many companies can't afford training and development personnel, and so this is a great opportunity to leverage Cal State's faculty to help them develop their learning programs.
The leadership of the center and the students allow me to not only bring leadership development to my company, but allow me to interact with some amazing students who have grit, potential, and just amazing futures in front of them, and I get to take part of that. It's a wonderful feeling.
When your organization is ready to develop its talent, reach out to the Center for Leadership, and we'll help get you there. Welcome back to the Leadership Voice. Our next guest is Robert Grant. Robert Edward Grant is a longtime businessman and entrepreneur with over 25 years' experience in founding and leading companies in healthcare, blockchain, clean tech, encryption, advanced cybernetics, and fintech. Robert is the founder, chairman, and managing partner of Strathspey Crown, a growth equity holding company based in Newport Beach, California, with a broad portfolio of company and asset holdings spanning healthcare, clean energy, social media, and fintech. He has taken 3 companies from startup to public offerings, including Evolus, Crown Sterling, and Aon. Please welcome Robert Grant.
Hi, Jay.
Robert, thanks for being on the show.
Good to see you.
And it's going to be great to talk a little bit about this whole process of going public with companies. Could you maybe start by sharing the story of your 3 companies that went public? Tell us about those journeys.
Well, the first one was a company called Evolus that it was basically started in 2013. And 5 years later, we took the company public. It was a pharmaceutical, it is today still a pharmaceutical company that's also now in medical devices. It does about $200 million a year in sales today. And we needed to take it public in order to be able to have access to the capital markets, which was a critical thing to do for us at that stage and time. And also we had a very important product that was coming to the market, which was a product called Jeuveau that competes with Botox. And it's done very well in the market since it's basically come in. They just got the approvals from the European Union to be able to market and access the whole consumer market, et cetera, that is there already. And it's been a very exciting company to watch grow.
And the second company was Crown Sterling.
Second company was Crown Sterling. So I founded that company in 2018. And, that was founded when I do a lot of work in mathematics. And so I discovered this prime number pattern and published it at Cornell. And after I published it, people were saying, hey, that's going to cause some issues you've identified a pattern in prime numbers, and that might cause issues for cryptography. So you might want to look at the impact of this from a cryptographic perspective. And we did. And we found that there were some geometric relationships to prime factorization. And so we founded a company on that premise, not even knowing whether or not we'd be able to, exploit this technology to its fullest. And we had to come up with an entirely new cryptographic protocol that was also quantum secure. And it required me to learn an entirely new industry. And then that company went public in 2021 on several exchanges. And it's done also very well. And we're launching the first quantum secure app for large group social media. So right now, there's no quantum secure messaging app like WhatsApp or Telegram that exists. And we created the very first one so that you can actually have very large groups on it as well. The largest you can have on WhatsApp, for example, is only about 1,000 people. On this platform, Orion it's called, you could have 1 million people or 10 million people or 20 million people. So it literally becomes a new foray into social media. And that's been an exciting company to watch grow and launch from the very beginning as well.
And then now we have a more recent public offering.
And Aon Biopharma was also another pharmaceutical company that wanted to gain access to the public markets and capital. And, we'd already put in total, the company had invested about $125 million into it. And so we took that public just very recently, only a few weeks ago. And that's also been very exciting. They're going after some exciting indications. One is for episodic migraine, headache, and sort of a new approach to it. And in addition to that, also they're targeting PTSD.
Okay. So you've founded, started up several companies. About 11 companies. Some you've taken public and some you've kept private. How do you decide which companies to keep private and which companies to go public with?
It really depends on the proprietariness of the business model and the proprietariness of the product. So if you have something and you're in a market segment that has a significant barrier to entry, that might be a candidate. It's not necessarily always going to be the case, but it might be a candidate to take that company public. If you've got some sort of unique angle. If you're selling widgets that everybody else sells, I probably wouldn't recommend, if you've got a lot of crowded competitors in the space, I probably wouldn't recommend to just go and run to take a company public unless you're already cash flowing, and then it's a different kind of asset class. So companies that generally go public in the healthcare space are going to be looking for, they have heavy funding needs and requirements. And so therefore they, at a certain stage, can no longer kind of tap into the venture capital community because, the cost for a clinical trial, for example, is gargantuan, right? For a biologic to go through the FDA, the average cost is about $1 billion. So to find venture capital for some opportunity like that is very, very challenging. And so you get to a certain stage and you say, okay, is the market ready? And usually you've got to be past your sort of phase twos or have some clear milestones that you can deliver against, right, in that biotech space. In the fintech market, right, it's a totally different beast. You want to be a very cash flow positive type thing because it's much more difficult to garner a technology or product that's going to be totally proprietary. So one of my companies is a company called Alpheon Credit. I founded the company also in 2012, and that now has grown to be the second largest healthcare lender, consumer lender in the United States. And that's been exciting. Now we have to make the decision, will that company, and we'll do that along with management. I'm just I guess I'm the largest shareholder, but we'll decide those kinds of decisions as we get closer to it. The company is very cash flow positive. It could be a candidate to go public. But when you're in that situation and it's issuing dividends and everything, sometimes you also kind of take a step back and say, do I want to go through that headache? Because if you've got a company that doesn't need access to capital, that's already got nice dividend flow coming off of it and is cash flowing well, then you don't really need to take it public. You can take it public if you want a liquidity event for your ownership. And that's going to be a timing question and how all the other shareholders feel about it.
Now, some CEOs, when they go public, it's with sort of a strategy of maybe moving on from the company. Mm-hmm. But others, it's a strategy for growth and strategy for taking the company to a next level. Is there another strategy that CEOs might consider if they're looking to continue to expand their business?
Beyond taking it public?
Ooh.
There's sort of like this old adage, right? We always say build, buy, or partner, right? And there's a point in time that I think every business has to come to make the decision. We kind of are at this crossroads. We have to either continue to build it on our own, right? We're going to buy someone else to get beefier, to get larger, or maybe we get bought by someone else. Or if those two avenues are not necessarily as advantageous, you might just pursue some sort of form of a partnership with a strategic partner. And I think that's a sandbox analysis that you kind of have to do as a strategist in your company, as a CEO generally, to take the bull by the horns and say, okay, I think the best option for us right now is to either take it public to sell it, or we're just going to continue sticking to our knitting and just continue to build the business and build it for long-term sustainability. Anyone who says that they think that, I'm going to become an entrepreneur so I can take a company public. Likewise, I think I said this to you last time as well. I've never met a founder that said, I'm going to basically found this company so I can be rich. I've never, ever met a founder who literally had that as their main thing to do. Usually founders want to create a ripple in the world. They want to create some change, right? Sometimes you'll find managers who want to just get rich. That happens often. But founders, it's pretty rare that you find a founder whose sole purpose was really just to kind of like take a company through the process to get it public and then bounce, right, and get out. Usually it's like, when people say to me, it's like, well, why do you found companies then? It's kind of like asking the question, why do you have more kids? Right? Because I look at each one of these companies as like my children in a way. I want them to succeed. I want them to grow. And taking them public is just one step. It's like taking them to college, right? It's just another stage in their life cycle. And ultimately, a founder wants to see that company succeed and thrive, right? And so if taking it public allows you to get access to capital, it allows you to get greater gross rating points, right, in the media, or it allows you to get access to a consumer base that you wouldn't otherwise have gotten access to because you needed them to know your brand name, then taking a company public can make a lot of sense. But, I would say and really caution people, taking a company public can be your worst nightmare because it can require a lot of extra work that you're probably not even thinking of right now, right? Just getting through an accounting process with EY or BDO Seidman or Grant Thornton or any one of these types of firms, and to put the kinds of control mechanisms in place and not have, single product risk and all the risk factors that get basically articulated in S1 documents, which is the filing that you do when you take a company public. These are all things that I think a lot of people get blindsided by. They don't really understand. And a lot of private companies can't even get past that hurdle because it's just too high a bar for them. So it's not for every company. It really is not.
So let's talk a little bit about your philosophies. And in this process of taking 3 different companies, and really you were involved in
the founding of all of them.
Yeah. But you were also involved at Allergan when they went public.
Well, Allergan was already public.
Mm-hmm. So what have you learned about IPOs that provide kind of a set of best practices?
I think that one of the things that's really good about the IPO process is this thing called TTW, right? And that stands for testing the waters. So you're allowed to do, now, there's a lot of weird things that I don't really like about Wall Street, to be honest, right? And one of them is the house always wins. And literally, I mean that, because it used to be that investment bankers would take us out on roadshows. I've been a public company CEO at a company called BioLays before I went to Allergan, in fact. And I remember becoming a public company CEO for the first time. I think it was 33 years old. And I woke up in the morning, and our market cap was small. We were like a $500 million market cap company. I woke up and I was like, went to the computer, right? Because on the East Coast, it was already 9:30 in the morning. And I looked on my computer to see how the market reacted. And I'm like, I turned it on, I'm like, oh, the stock price is up. They like me. It's so funny. And you get sucked into this mentality that's sort of like some form of validation of who you are on what happens with the stock price. And then after a while, you get beat up enough times that you realize, I don't think I want to ascribe my my own self-worth to just what happens with the stock price.
Stock price shouldn't be your love language.
It can be, totally not. So you've got to be able to look beyond that stock price and realize that the things that you have to do, and as a CEO, you kind of have to split your job up into, a third of my time I have to spend probably with investors, right? A third of my time I like to spend with customers because those are the most important of the 3 constituents, in my opinion, right? A company to succeed, if you really want a company to succeed, it should always be oriented around customer willingness to recommend and employee willingness to recommend. If you can drive strong metrics there, you'll never have a hard time hiring people, and you'll always have a business that has some sustainability associated with it if you truly understand your customer. But companies that try to please Wall Street, good luck. That's when Wall Street really doesn't get pleased. It's kind of like if you want to get a loan from a bank, the worst time to go to a bank is when you need a loan. They'll never give you a loan. You want to get a loan when you don't need a loan. You want to be able to get credit when you don't need it. It's also true with Wall Street. If you're seeking Wall Street's validation, you're not going to get it. It's very, very difficult. You have to do the things that underlie the success before you're going to get the recognition from Wall Street or anybody else. So I think that's been a really key thing. When IPOs go out with a true understanding of where they are in the market, who they are serving, and have already completed many, many TTW meetings, testing the waters meetings with their investment banks, then they've got a better chance of being able to have, as soon as shares become unlocked and everything and liquidity becomes more fluid in your stock, then you can sort of weather the storm. And then don't make little stupid mistakes. Like little things that can come up with somebody, filing a Form 4 or something like that was just misconstrued can basically tank your stock price because people don't understand that. Or if a member of management decides, I'm buying a house and so therefore I'm going to sell some stock. One of the things that people don't realize, it's almost impossible for a CEO of a company to ever get liquidity until he leaves the company. It's literally that difficult because the pressure that you get to hold on to your stock by all the different constituencies is very, very high. And as soon as you send the signal that you're selling your stock, even if it's just to buy a house, optics. So that's an angle of it where you're going beyond just building the business for the customer's benefit. You also have to be able to know how to represent yourself in a credible manner. And that's what I think the TTW process and the roadshow process helps you do, because you have to practice it over and over and over again to hone those skills to get you ready to be public.
Are there any other mistakes that CEOs need to be careful to not make? Or what are the risks of a poorly executed IPO?
I think the major risks are access to capital. So, and also public perception. If your stock price tanks, then it becomes more difficult for you to get access to more capital, right? And that's difficult. It doesn't mean you can't survive it. You can. You can climb out of it. You know, Evolus went through a period of time a few years back when it had a big lawsuit, and you know it was a bizarre lawsuit, but it got kind of scary for the company because it was kind of a bet the company lawsuit. Ultimately, it all worked out, but the stock price came under dramatic pressure during the height of that sort of crisis situation, and but it since recovered. You know, it's up 5-6 times from where it was then. So you can recover those things. It just, you know, what it takes you a long time to build in reputation, you can lose in minutes, right, with Wall Street. That's the thing. Reputation takes a long time to build, but it can be lost in literally minutes or seconds even when bad things happen. And they often do happen. They're not being prepared for the storm, right? And then also being prepared sometimes when the storm shows up and there wasn't really a storm. Right? That also happens too. We all experienced that this last week, right? I was watching some funny memes and also funny videos of guys walking around their patio this morning saying, oh, look, I'm surveying the damage in my backyard. There's like one leaf on my patio. You know, it was kind of that type of thing. That happens in public companies too. Things that people think, you know, things are never as good as they seem and they're never as bad as they seem either.
So what advice would you give a startup that wants to go public? You'd say, hey, before you do that, what would you say to them?
The first thing I would say is, do you have audited financials? Because that's probably one of the longest lead items to being able to be a successfully, to be able to get listed in the first place, right? And nowadays, it's gotten more and more difficult to get listed. They've changed all the rules, right? The amount of cash you need on a balance sheet is dramatically higher than it used to be, right? Literally everything, it's like government. You know, governments don't get smaller, they get bigger because we get more and more rules with time as people make more and more mistakes. And then we try to correct for every possible mistake, and then we have overregulation, right? And so in effect, that's what's happened on Wall Street. It used to be much easier. I could take a company public like 5-10 years ago, and the investment banks would actually do work, right? They would actually go out and build a book for you. Now it's like, no, we want you, if you're going to take it public, we'll sell your house as long as you buy it from yourself. And what do I mean by that? Well, normally people think that when you take a company public, you go through the S-1 process, you're going to do a sale of primary stock, right? And so there's going to be a proceed that's going to be associated with the sale of that stock. Well, what I'm describing to you is it used to be you pay a commission on money that they go out and sell your stock for you, and you pay them a commission to sell your stock. But now they want you to fully subscribe your own book before they'll even go out and do a roadshow. Because it's much easier, they found, to go out and sell an IPO that's got a fully subscribed book already. And this isn't in every industry, but it's become the norm in the healthcare space for sure. And so they look at it as like, well, that's kind of like our sieve or the way we separate the wheat from the chaff. And I don't know that that's always the right thing, but it's definitely easier for investment banks. So I would say make sure that you get an investment bank that is really caring about your company and your story, because if anyone is in it to just make a quick buck, it's the investment banker. It's not the founder, it's the investment banker. So they're always going to gravitate towards the lowest hanging fruit and the easiest path of success. And sometimes as long as your interests are aligned with that, then you guys can work together fine. If your interests become juxtaposed, then you're going to have challenges getting to the market. But certainly you can't even get to this conversation without having audited financials. And if you don't already have that, then you're going to need that for at least a couple of years on average before you can actually even start thinking about stub years and stuff like that. So you can have like 3 years of audited financials.
Now, these are some great ideas. Robert, I want to thank you for joining us on today's show and this interview. And in a few minutes, we're going to have Dean Stoker on set with us. We're going to do a panel. We'll be able to talk more about IPOs and some of these kinds of challenges.
Yep, absolutely.
It's now time for our leadership example. Today's leadership example comes from dealroom.com. We bring you the 11 biggest IPOs of all time. It's now time for today's leadership lesson. Every episode, we bring you a faculty expert to shine light on the theme of the day. Today's theme, taking a company public. And today's leadership lesson will be delivered by Lorenzo Bizzi.
Hello, I am Lorenzo Bizzi, and today's leadership lesson is about leadership during an IPO. As a founder CEO, when you want to take your company public, there are a lot of issues that cloud your mind. Discounted cash flow analysis, pricing strategy, underwriter fees, lockups, or dual-class shares. But there's one crucial issue that gets often overlooked, resulting in major problems for your organization. What do you tell your employees as their leader? You see, an IPO is a major change for your organization. This change will cause uncertainty in your employees, and the uncertainty might raise resistance that hampers organizational effectiveness and does not allow you to attain the very benefits that the IPO is supposed to give. So let's see together what we need to address with your managers and employees. 3 issues. First, how does the IPO change your leadership role? There's a famous dilemma, the founder's dilemma. Founders can either choose to remain kings or queens or become rich. They can't be both. They either sell their shares to raise capital that fuels growth, thereby allowing them to make big money but lose control, or they retain control but inevitably constrain growth. If you sell your shares, will the IPO lower your power in the organization? And how will this affect your relationship with management and employees? Second, how does the IPO change the structure of the organization? The capital raised will be allocated differently to the divisions or functions. Some units will gain, some units will lose. This will inevitably alter the structure of power in the organization, possibly creating new tensions and conflicts. Help your managers understand this crucial matter in advance. Third, how does the IPO change your organizational goals? When a company is private, CEOs are not accountable to the market. They are free to pursue long-term goals. When the company turns public, pressure for short-term results increases. The CEO becomes accountable for quarterly results. This might alter the goals of managers and employees, and you need to make sure they understand the implications of the IPO on their accountability. As conclusion, the IPO is a beautiful opportunity to raise capital needed to fuel your growth, finance the acquisition of new assets, and solidify your competitive position. But never underestimate the importance of maintaining a clear channel of communication with your managers and your employees so that you can appropriate the benefits the IPO can give. I am Lorenzo Bizzi, and this has been your leadership lesson.
Thank you, Professor Bizzi, for that thought-provoking leadership lesson. We brought back our 2 guests for today's leadership panel. Dean and Robert, thanks again for coming back. All right, so we're going to ask 4 questions. You're each going to have a chance to answer both of them. Dean's going to answer the first one, but Robert, you'll be answering it as well. So the first question is, what do entrepreneurs underestimate when going public with their startup companies?
Well, it's clear that they underestimate the sea change in your work life. You are kind of forced to move from tending to the company to tending to investors and all the rigors of going public. So, you can't underestimate the kind of work that's going to be required. You will see your family a lot less. You will see your employees a lot less. You'll see your customers a lot less, and you'll be spending a lot more of your time with public investors who want to get to know you and the company and hear the story and try to figure out what's wrong.
All right. Robert, same question. What do a lot of CEOs underestimate when they're going public?
The amount of time that it takes to take a company public and how much is outside of what they're doing inside of the company. So much of going public has to do with timing of markets and what are the circumstances. Is the market a fertile market for any type of transaction? And very often it's not. So it tends to, Wall Street tends to be this cattle kind of response to everything. There's a herd mentality. When things are good, things are really good. And when things are bad, things are really bad. But things are never as good as they seem and never as bad as they seem either. So I think that CEOs in particular and management teams have no clue about the number of meetings that it takes to get a company public. It's an amazing amount of meetings and an amazing mountain of paperwork. So you can bet that for at least the 6 to 9 months prior to taking a company public, that is going to be your life. And then once you do get public, just as Dean said, I totally agree, your entire life changes because you no longer have the constituencies of your customer base to make sure that they're happy and their care and feeding is taken care of, and also your employee base. But now you've also got this investor base. And, even though you may have had a board of directors prior to going public, very often you would, of course, the whole process flow around it changes dramatically. The board member who is a public company board member feels his job is not to push the company to greatness per se, but more to provide this balancing act against the CEO trying to push it towards something that might be too risky. So everything starts to devolve towards more of a common denominator of what the lowest risk decisions are. And that changes dramatically the nature of the company, both vis-a-vis your competitors and how you operate in the market segment. And it can really curtail the amount of risk that you take on as well.
Especially in this kind of a macroeconomic condition. Remember, we had free money from the Fed for the last 10 years, so it was, growth at any cost. And now it's a complete pivot to, cash flow. And the rule of 40 has changed quite a bit. And I think in this market, it's very, very hard to go public, just evidenced by the numbers of IPOs that have not happened this year.
Okay, so our second question is going to be, Robert's going to go first, and Dean, you'll have a chance to answer as well. And it's about the changing roles of a CEO. How is being a CEO of a private company different from a public company? How does the job change?
It's funny. A lot of people believe that when you're going up against a major company that's already an incumbent from a competitive perspective with a new product, that company, depending on how much profit they generate, is going to have so much more spending power to sort of spend you into oblivion, and you won't be able to compete with them. So they think, I'll take the company public so I can accumulate a lot of cash through a primary sale of stock and be able to take on the big behemoth. Well, the truth is that your entire role shifts. As a public company CEO, what matters very often more than your aggregate profitability is your comparative profitability versus the prior year. So very often you can have a gigantic company that's cash flowing tons, billions of dollars, but they are almost locked in their position and unable to really compete because they're dealing with very, very significant higher expectations on earnings per share growth. It's earnings per share growth that matters a lot in how your public perception is viewed. It's not even about the aggregate of profitability you achieved. And for people that have been used to running businesses and they can say, well, this year we had to invest more in the company, right? We had to make these investments more significantly to fend off competitive threats. Now, as a public company, the degrees of freedom to do that are impinged upon quite substantively. And I think a lot of people don't understand how painful that can be when you go from being the new up-and-comer to becoming the incumbent. That shift can be very, very dramatic and swift.
Yeah, you go from being the hunters to being the hunted very quickly. And the moat is not nearly as deep and wide as you originally thought when you're going up against these folks, because they're comparing you to the patterns that they've seen. The investors are comparing you to the patterns they have seen in all of your peer class.
All right. So our third question is going to be, Dean's going to answer first. And that is, what would you say are the three most important things that CEOs must attend to leading up to an IPO? be the three most important things?
Financial discipline, one. You have to be spot on with predictability. I mean, you can't miss. You get, in a matter of moments, if you miss, you're done and maybe put in the doghouse for several quarters. I think that CEOs have to tend to the culture of the company, because it's not just a change for the CEO and the executive leadership team. It's the whole company has to change, and you have to set expectations within the company's ranks so they understand what's going to change for them in their own personal lives. And third, I think that you still have to maintain a healthy life-work balance, and that's hard to do. I think that's, I love marriage so much I did it twice, and I think that the rigors of work, takes you away from the people you love, and it's just a challenge. So be prepared for these things.
God, Robert?
I would say that what Dean was just basically articulating is something that I definitely experienced. As a public company CEO, my entire life shifted dramatically one day to the next, and I had no clue that it was going to be such a rapid shift. The things that I figured were my metrics for success were changed immediately as well. Obviously the financial discipline is a critical aspect of it. I mentioned already audited financials and all that. That's another aspect. But in addition to that, you have to make sure that you can get through that process and not have, single product risk, not have the risk associated with, not having a separation of duties, right? Because the thing that can blow you up very often is some little thing that you have no clue about that could come up. A CFO has a problem with one of his employees or something like that then can derail him as a CFO. And then you're having to deal with that publicly. So everything you do in this public context has to be with this management of expectations in mind. Success in business is not so much about what you achieve, it's about what you said you were going to achieve and achieving that or better, and doing that consistently. When I first became a public company CEO, one of the best pieces of advice I got was from a guy by the name of Bernard Couillot, who was one of my mentors and CEO of Coherent when I used to work for Coherent up in the Bay Area. And he said to me, he's like, okay, you're a CEO now. I said, yeah. He says, if you miss on a quarterly basis, right, make sure you take advantage of it. He said, first of all, don't miss your numbers. But if you do, make sure you take advantage of it and you pull way back on the expectations. So you give yourself a reset, because you're not going to be given that chance again. And he was right. He's absolutely right. So, it's like that old story. I don't know if you've heard this story, but it's like a CEO starts his new job as a public company CEO, and he opens his desk and he finds this letter in there. And it says, open after the first year, right? And so he forgets about it. Have you heard this before? He forgets about it, and then he's trying to make his company successful and everything, and he's like, I don't know what to do. I can't get my earnings per share growth going. I'm not succeeding. So he rummaging around his desk, he finds this letter open after year one. He opens a letter and it says, reorganize the company.
Well, at the same time, while we're suggesting that things are going to change, there's some things that don't have to change. For myself, for example, my KPIs, while my behaviors changed a lot in the way I spoke to the public audience and to the employees of the company, my KPIs never changed from private to public. It was always NPS coming from customers, which was led by NPS coming from employees, resulting in net revenue retention, because that was the one thing that I knew that Wall Street wanted. So you don't have to change your whole life.
No.
You have to change a big part of it, though.
But maybe do you think that was part and parcel also of the stage at which you were already sort of matured as a business before you decided to go public?
Well, I think that's almost entirely it. We went through a couple of years of preparation. We did our pre-IPO audit 14 months before, and we uncovered, things that we needed to fix, those little red buttons instead of the yellow buttons and the green buttons. So preparation led, I think, to the ability to maintain some of the things like KPIs.
Yeah, well, when the CEO opens the desk and he finds after the second year and nothing's worked and he's failed, right? It's like, then buy another company.
Okay, so there's several envelopes in here.
Yeah,
that's right. That's
and
right.
and then the third envelope is write 3 letters. Right, so there's
To your successor.
That's right, to your successor. So these are kind of the jokes that CEOs will often tell to each other, right? Because these are the things that we all kind of fall into, some of which, it's just like, here are the wise rules for the road. Don't get ahead of yourself. Don't get ahead of your skis, right? Don't overpromise. It's so tempting sometimes to overpromise. You have to be able to deliver on what you said you were going to do. That's going to be the most important thing. If you can consistently do that, even if it's only a little bit better or just exactly what you said, that's better than missing and getting ahead of yourself and getting, too far in front of your skis.
Something that came up earlier, and I wanted us to circle on, and that is the idea of how going public can affect the culture in a company. Could you talk a little bit about how the culture can get impacted and what we need to do to maintain the company's culture during this process?
Well, I think the CEO's primary job is first go to product market fit and then maintaining the corporate culture. So I spent a lot of time attending QBRs, all hands meetings, theater meetings around the world to make sure people were still intact, that they were still going to be entrepreneurial in a public company, but providing some lessons around what you can't do any longer. And it's hard. A lot of people tap out. They don't want to go public. Some of my leadership team said, to go public, I don't want to do that. And it's because they can't handle a cultural shift. But it's a delicate process for CEOs to manage, for sure.
Robert?
It's also one of those things, it's like, now of all the things that a CEO already has to deal with, now you also have to deal with, if your stock price is up, you come to the office and you're like a hero. Everyone's happy. It's amazing, right? It's all amazing. Like, yeah, we did it. Yeah. Even though it may have only had to do with the market expanding, right? It could have been just the Dow Jones was up, 200 points or something that day. But when it's down, it's definitely clear it's your fault. And dealing with that is not as easy as you would think. It's like, oh, that's the market. Well, market's market. It's like, but the whole market's down. It's like, yeah, they don't want to hear that, right? And it's a different dynamic to have to deal with. And it's something that I think a lot of people wouldn't necessarily expect, but it becomes a part of your culture. What happens with the way your company is perceived becomes a lot more important in the eyes of your employees reputationally and in their work life too. Their career, all these new aspects start to come into play, and whether or not they want to be part of, this machine. Whereas before it was more like a family. Everyone's doing this together. We're in this together. We're going after it. And now it's going to be more like okay, so now it's the corporate machine. And then people don't necessarily want to be as entrepreneurial. They don't want to take as big a risk. They don't want to put in the extra hours. And that definitely can shift the culture. Have you found that too?
Yep. Very much true.
So now we're at the time of our show where each of you gets to share some final piece of wisdom. We call it the final word. So each of you get one last chance to kind of share something that maybe we haven't already talked about, or something you'd like our viewers to remember about today's show. And Robert will go first.
I think that if your desire, and I think Dean said this earlier, we're during our last little session, but if your desire is to get rich, there are a lot of better ways to get rich than to take your company public, to be honest. And if your desire, I've never met successful entrepreneurs whose sole desire was to get rich. If your desire is to change the world, if your desire is to make your product, put it in a position where it has the ability to potentially change the world, or the service you're providing, then going public is one option that gets you the ability to be able to have access to greater amounts of capital, and gets you access to liquidity as well that you might not have otherwise have had access to. Meaning that as a founder or as one of the management team members, it's very difficult for the CEO because they still have to announce when they're going to sell any stock. But you can get loans again. So there are things like that so that you can buy a house and you don't have to be impoverished forever. And very often, a lot of people don't know that CEOs that have to put in the time to get to the stage of taking a company public have gone often many years without having salaries. And that's not easy. So it's, you're thinking, okay, I'm going to get my liquidity event when they take the company public, but very often that's not when you get a liquidity event. And you have to have more patience still. but being able to weather those storms is a critical aspect of success.
Yeah, I think going public is the last best option that you should have. And for the most part, you should be building a business, real customers with real recurring revenue, changing the world. And at some point, you might make that decision, but you shouldn't utter it out of your mouth until you're $50 to $100 million, in my opinion.
And there you have it, our final word. Thank you, Dean and Robert, for joining us on today's show and sharing your wisdom with our audience. If you have a question or need advice, connect with us by email, leadership@fullerton.edu, or on Instagram @CSUF_CFL. Thank you for tuning in to today's show, where we discuss the challenges of taking a company public. Thanks to our featured guests, Dean Stoker and Robert Grant, for sharing your wisdom on this important topic. A special thanks to Professor Lorenzo Bizzi for delivering today's leadership lesson. Join us each episode of The Leadership Voice, where we bring you expert leadership insights across many important topics. I'm Jay Barbuto here at the Giles O'Malley Center for Leadership at Cal State Fullerton. And we'll see you next time right here on The Leadership Voice.